Ready?
Yeah.
Hi, this is Mike Swatson. I'm here with Dave Scarica down in the Bahamas, and we thought we'd talk about some of the wild things going on in the stock market, man. I mean, all these debt problems are blowing up in Greece and Europe, and now they're talking about Italy and Spain and Portugal and on and on. And one thing about it that's been interesting, though, is last week when that was going on, gold was really strong.
Yeah.
You know, gold almost hit a new all-time high, and it was really serving as a safe haven. And one thing I always wonder about is this like a preview of some stuff that's going to happen one day in the United States?
Well, I've been saying this all along. My whole thesis in the last year or two has been that the governments have now essentially taken on all the debts, because they bailed the banking systems and the whatnot. And obviously, certain countries like Canada and Australia, which have stable banking systems, have the advantage over that. And so that's what I thought. And then at some point, the debt crisis is going to go into the government. And obviously, a place like Greece, which is quite socialistic, has a large government sector and is really overextended. People were crooked, they're not paying their taxes. They're a little ahead of the curve in terms of where they were in their debt crisis. And they had a higher debt GDP entering the crisis to begin with. So, yeah, I think this will happen in the States one day. Obviously, it's happening in Europe first. The U.S. is always benefiting from the fact that it is the world's reserve currency. So, like, people go into it when when they're really fearful, and it's still the largest, most liquid financial market in the world. But I definitely think that at some point, we're going to see this debt crisis go to the States. The reason I don't think it's happening now is simply the bond market. When you have the 30-year bond and 10-year bonds way up this year in the U.S., and even the large bond markets all over the world, like Germany and even England, these places are all up, while these little debt markets like Spain and Greece got slaughtered, it tells us that right now it's still insulated to these smaller markets, and it's not spread yet. When you'll see the debt crisis in the U.S., it's going to happen what happens in Greece. Like the long-term bond is going to get slaughtered, and rates are going to spike up. And anytime there's a run on a currency, that's what happens. Like if you look at even when Soros broke the pound, that was just a small like decline that lasted a few weeks kind of thing. And same thing, the British interest rates spiked during that period. So I think that's when you'll get the real debt crisis in the United States. And the second part is gold. One comment I've been making all along recently is I have not been correct in terms of the euro. I thought the euro was going to bottom in the low 30s and it smashed down. But one comment I made is, if the euro gets out of control here to the downside, that's going to mean the dollar is going to go up. But gold will not go down in that context. Gold is going to go up because it's a currency crisis. The dollar is just going up because the euro is going down. People aren't going to totally rush into dollars. They're going to be going into gold as a safe haven. And that's exactly what we've seen. Gold hit like $1,200 an ounce, basically within a few dollars of its high back in November, December 2009.
Well, do you think something could happen in the United States similar to what's happening in Greece? Do you see this as something that could happen within a few months or weeks, or talking about way down the road?
I don't even think these other pigs are going to have it happen in a few months. I think a lot of this contagion is really overblown. I think Portugal is definitely one that's a risk it could spread to. But Portugal and Greece are minor players. You're talking 2 to 3% of the euro economy. Like I tell people where I live here in the Bahamas, it's essentially I would consider it a second world country. And the GDP per capita here is about, depending on the measure, between 27 and 30,000 per person. And Portugal is 22,000. So that Portugal has a way lower standard of living than even the Bahamas. It's not a prosperous country, and it's small. And then you have Greece and their debt levels. Like Spain, for example, its debt to GDP is 54%. Now, they have a problem. They have a lot of private debt. Their economy was based on the bubble in real estate, and it's going to be difficult for them to recover, and they have large deficits. But it's actually nowhere close to being in that kind of default mode right now. And then you look at UK, is the same thing. Big deficit problem, was a financial-based economy, a lot of problems, but the debt to GDP in the UK is only about 60 to 65%. So again, when you're at that levels, you're in no fear of default. In Italy, all their debt is domestically held. So again, and usually your own people don't dump your debt. Your biggest problem is when foreigners own your debt and they dump it. And Italy's always had those higher debt to GDP levels. Probably part of the reason is because they have a huge black market economy, so probably their economy is a lot larger than that is being reported. And Ireland has actually taken very strict steps towards cutting their deficit. So I don't see the other pigs as these problems. And I think, people are, Greece is definitely a problem, and I think Greece should actually do a partial default. But I just don't, I think a lot of this other stuff is being overblown, and we've talked about this. When this happened in the Asian crisis, or you got an Argentinian default to Russia, there's always 5 or 10 other countries that they throw out there as, they're going to blow up tomorrow. And then maybe they're not in the best of shape, but it never seems like it really goes full bore.
Yeah, that's what this really reminds me of, is 1998, when there was the Russian crisis and long-term capital management, and then 97 when there was the Asian crises, where in both these times the market had very severe corrections, and there's lots of fear and panic and lots of scary stuff. And like you're saying, each time something happened, the fear was it's going to spread everywhere. And what would happen though during those times is that as a result of all these troubles overseas, the United States became sort of a safe haven for the global monetary system. The dollar
went
up, had a very powerful bull market, and money flocked into the United States stock markets too. And with interest rates so low, and no sign of them raising interest rates probably till next year, it would seem to me that there's a good chance that we're going to have a scenario where once this correction is over with and the market starts to go back up, that there's going to be continued strength in the United States when compared with other market averages. We may even see another new stock market bubble form over the next year, and then when the next time the Fed raises interest rates or whatever, I really think more problems would be much farther down the road. Any debt stuff from here.
I think, and I don't want to sound like too doom and gloomish, but you're right that you talk about the safe haven play into the States, and I think this is going to be the last time this happens, because the next bubble I see is kind of being the debt bubble in the United States blowing up, and at that point the dollar is really going to fall hard. Maybe not the dollar index, to the euro has so many problems, but against the stable currencies that look strong, like the real and the Canadian and Aussie dollars, and maybe the yuan if they let it flow. So that this is going to be kind of the last time that I think you see this sort of thing. And on the interest rate front, when they finally do have a debt a problem in the States, we just saw what happened in Greece. Their long-term rates were 4% 6 months ago, and now it's 12, 13, maybe into the mid-teens in some of the cases.
Yeah.
And I think you'll see that in the States. When these debt bubbles burst, it happens really, really quick.
Mm-hmm.
So, and you can just see that if you look at the long-term rates during the 70s, like the 74 bear market, when there's high inflation, or 1980 to 82, you'll see these huge spikes, and interest rates can double and triple maybe in less than a year. So when it does happen, it will happen quickly. And I think what people have to see here is you have to position yourself for this. Like you said, I really don't see this as the start of the big, huge washout decline in the United States stock market. And if it does continue to lead the way, you should position yourself. Like the S&P gets back up to the 1,200-1,300 area, you should be selling, in my opinion, you should be taking some profits in long-term positions and then positioning yourself for the next crisis. Like you could see that Greece had a lot of problems, and it looked like the euro and the sentiment was terrible towards the dollar, so it looked like the euro was going to fall a bit, and you knew that gold was going to benefit from this. So you could have started positioning yourself for this like late last year. Just like the financial crisis, you could see that the housing market was blowing up and there'd probably be a bear market. So right now, I think in the next year, and this is where I think I come in, because I do a lot in these gold and precious metal stocks, and I think like all these debt bubbles are going to lead to what we're seeing in gold right now is nothing compared to what's going to happen. And I think now you can kind of position yourself for that. And I think you have to think outside of the box. So the problem with this U.S. dollar index is it's 6 currencies, and 57% of the weighting is the euro. And there's a lot of currencies that I would consider looking at, like the Aussie dollar or the Brazilian real or the rupee, that aren't even in the U.S. dollar index. So again, like just position yourselves in different ways, and that's what I think I would use over the next year. And by the way, I do agree with you. I think what you're going to see too, if we're nearing a short-term bottom, and say this is just a correction and the market bottoms here, on the coming rally, the U.S. and probably some of the Asian markets will outperform, probably Canada as well, a lot of these European markets. I think they'll continue to lag.
Oh, for sure. So let me ask you this, because you're basically the expert on gold stocks. What about gold stocks? They've kind of lagged the price of metal.
This is perfect.
Lately, and it seems like they're so undervalued. Are they ever going to catch up? And if you think they will, what's type of gold stocks are worth buying?
I think they already somewhat have caught up. If you look at where they were during the financial crisis, they're a maybe all-time lows in terms of valuation compared to the gold price. So now they've gotten to the point now where they're at a low valuation, but they're not at these ultra-cheap levels. For example, the HUI has tripled off its bottom, roughly. And gold has gone up about 80% off its bottom. So it's definitely outperformed since then. But again, I think when you look at this market here, if we're right, even if the market tops, it's going to have a period of sideways movement. And when that happens and the market finally stabilizes, the gold stocks get hit when the stock market goes down because they're equities, and they get sold like everything else. And as long as the selling is not out of control or the market can stabilize a bit, I think then they're going to catch up to the price of gold at some point. Like let's say the S&P rallies like 5% and gold stays flat. The gold stocks could rally 10% in that case because they're catching up to the price of gold. And by the way, we saw that this past week. When the market had one of the days where it tanked like 200 points, the next day it was flat. The gold stocks were flat the day it fell like 200 points. And the next day the gold stocks were up like 3-4% because they didn't have that selling pressure. So I think at some point the market is going to like flatten out and the gold stocks will move higher. And if I'm right too, this next bear market that we're talking about, I think it's going to be a more mild bear market. I don't think it's going to be a complete collapse like we saw in 2008. And under that circumstance, like the bear markets of the 70s, gold stocks can do really well as long as it's not that overwhelming.
Well, even in the last.
Sure. So yeah, now this is a part of the positioning that I just mentioned. That you just mentioned, the gold stocks are cheap. So if they're cheap, you should, again, maybe they're lagging right now, but they're not lagging because they're showing signs of weakness. They're lagging because of the market, and you take advantage of that to buy some of these stocks when they're cheap.
Well, even in 2002, when we had a bear market then, the gold stocks actually went up in the last year of that bear market. And then they peaked out in July or something. But they were going up during that bear market for a good part of the time. But one other thing I was thinking, too, about the stock market is I like to look at different sectors in the market and how they perform. And there's a pattern that tends to repeat in cyclical bull markets where commodity and inflation-related stocks tend to underperform at the beginning of the bull market, and then outperform towards the end as inflation starts to danger signs of inflation start to appear. So I would think that at some point this year, we'll see energy stocks, gold stocks, and commodity stocks start to do that. See leadership shift into there too.
Yeah, and if you look at that, you see that those stocks have not outperformed at all. And like you said, because that happens maybe sometimes near the end, that's real positive because it means that we're not near the end of the bull market.
Yeah, it's a positive sign right now.
No, right now, yeah. But again, I think you have to take advantage of it. And again, I think when you have these declines, people have to look at, you can trade the S&P, you can get rallies, blah, blah, blah. But if you're someone who's more of a longer-term type trader, the secular uptrend is still in gold and gold stocks and precious metals and some other commodities. I think that's where you actually want to buy in these declines. And we get sometimes assessed in our business with looking at the S&P 500 and the Dow, when maybe now you should be like for example, the perfect example was the financial crisis, like I just mentioned. The gold stocks got beaten up like crazy, and they ended up being a way better buy down there at that bottom than a lot of Dow stocks. Maybe a lot of Dow stocks went up 50%, 70%. A lot of those gold stocks went up 200-300% off their lows. So I think you should be looking at those kind of sectors when we're seeing these declines and weakness. Like let's say the stock market rallies a bit. Gold could pull back because, some of the fear comes out of the market. But my opinion is this year, if it pulls back in the middle of this year, 2010, that's the seasonal weak period. and you got to take advantage of that.
Mm-hmm.
And you know, obviously, something like my publication or Mike's publication, what we do is, you know, we'll actually pick stocks that will take advantage of that going forward. And so that's what I'm kind of looking at here. And right now, one of the areas of the sector I like these larger juniors, you know, that have resources or are near production, because I think that's where a lot of the value in the gold sector is.
Well, one thing that's good about just kind of lucked out here in a certain sense, but one problem I've run into sometimes is as someone, you know, having a trading service, is there are times when I don't really feel comfortable making new recommendations, and that was going on in April because the market had gone up so much in earnings period, and I thought there was a danger that, you know, we would see a correction or a top was being made, and I like to buy during corrections.
I agree.
Not at tops. But the problem is when people first sign up, a lot of people, they want action right then, or they get angry if you tell them it's time to be cautious. And now we're in a time where we're going through this correction that we've seen, which makes it the perfect time, really, to sign up for your service and start looking at what you're doing and getting some real good trading and investment
For example,
ideas.
the first offer we ever did through you was about, or you know, for me through you was like last year in February, March. And if you remember, I was really bullish on the market right near the bottom then. And for my first strong of, you know, I had stuff like Tata Motors on my list at $4 and blah, blah, blah. And that was nice because the problem is we did some later promotions, and because the market had gone up a lot, I was like, no, I really don't want to buy here.
And people don't understand,
and people don't understand that.
Why.
And people don't understand that when you sign up for a service like this, and this is a bit of shameless promotion here, but when you sign up for a service like this, you gotta just cancel after a couple months, because sometimes Mike and I are, you know, we're not gonna just chase everything, and we want to be patient to give you the best trades, and then we're going to like wait for those trades, and you have to be willing to wait. Because like this, look at this correction that just happened.
Now you can take advantage of it.
Yeah, we and you both haven't done any really new recommendations in the last 3 or 4 months because we're waiting for something like this to occur.
And here it is.
And here it is. So a lot of times I get people like, hey, Dave, you're not trading enough, this and that. And I'm like, well, okay, man, the market's overbought. I just want to wait a bit. And, you know, I don't think there's much upside here anyhow. And people really have to understand that. And that benefits everyone in the end because you're buying lower risk type trades then.
No, for sure. So when you sign up for this, you know, you're just doing it at the exact right moment to really.
Yeah, these are the times we
on.
wait for.
Yeah,
you know,
exactly.
You know.
So, but anyway, we'll be talking to y'all later.
See you later.